Generalized conversations have no business in real estate.
This is all reflected of this shift that we have in our nation of a wealth and talent migration that's happening. And it's still very much early days, and we're on the receiving end of it.
Joining us is Ana Bozovic, founder of Analytics Miami and a data-driven market analyst known for long-term trend reports that have become industry standards. She's a 4-term governor of the Miami Association of Realtors, major outlets, from the Wall Street Journal to The Real Deal. Regularly cite her work, and she's spoken at Inman Miami on wealth and migration, reshaping South Florida. A Columbia-trained mathematician, Ana brings proof-level rigor to what's really moving Miami's market.
Miami is a heavily all-cash market, and the higher up you go in price, the more all-cash it is. So past $2,000 a square foot, we're over 80% all-cash, both for condos and for single-family homes. We're actually up year over year for transaction volume, and while inventory levels are up, they're not up nearly as much as sales volume is, which means that it's actually tightened.
Get ready for a revealing conversation. We'll go beyond the headlines to uncover the data driving Miami's real estate market, from cash flow dynamics to inventory traps and the buildings that hide risk in plain view. This is Better Decisions.
Welcome back to the Better Decisions podcast. I'm excited today to unwrap with Ana Bozovic, my very good friend and expert in the market, fellow real estate analyst and general all-round numbers nerd. What's going on with this UBS Real Estate Bubble Index report that came out. We're going to get into the whole ideas of bubble trouble.
I love it.
Okay, so Ana, I know you are you're not backwards in coming forwards. You have a very strong opinion of this. Let's start off by going into what this report says. And then we're going to kind of deconstruct what bubbles actually are. Correct. And how they work in Miami and the reality behind the hype and the narrative. So start off by, first of all, again, I know you've done this so many times, but I think for those who may be first-time watchers out there, just detail your authority as a market analyst and an expert in South Florida. So where you come from has that kind of high level
some context
respect
for people.
Exactly, please.
Okay, perfect. So I founded Analytics Miami about 10 years ago, and I publish quarterly deep dive long-term trend analysis reports in the South Florida markets. The reports have become an industry standard. I'm quoted in all sorts of press, the Wall Street, all of them, all the press for many, many years.
I can name
I'm not going to list them all.
It's New York Times, Wall Street Journal, Real Deal, Curbed, probably the
Fox
UK
News
Times,
recently,
Fox News. I mean, you're like equal opportunity across.
Equal opportunity truth spreader. That's how I put it.
Yeah.
Yes.
And I think that's what this is about. This is about truth. It's not about clickbait. Too much of the stuff that we're seeing online right now is getting way too clickbaity. And this is a report that came out from the UBS group that stated it's the UBS Real Estate Bubble Index for 2025 that put Miami as number 1 in the world as having the city at the highest risk of being a bubble.
They did so last year as well, I believe. They had a similar report last year, and they've repeated it this year. Before I get into this report, which unfortunately has been repeated worldwide in headlines, just add some more context to my thought process. So I studied theoretical math and physics at Columbia University, and so I approach things like proofs. When you write a proof, you have to write a chain of logic, essentially. You have to define your terms, define your space, and have a chain of logic with which you reach your conclusion. And everything has to be substantiated every step of the way.
So you have a very scientific approach, very mathematical, and on top of that, and I'll help within this process, we will add to that the real on-the-ground, real-world narrative that we experience every day by actually doing this for a living in the city that we're talking about.
1,000%. And the authors of this report are not even in this country. I'm just going to add that there. But that isn't even the point, because if their work was rigorous, it wouldn't matter where they are. That isn't even my issue.
That's okay.
The issue.
So what did they say? Let's get into
Yes.
what they actually said, and then I want you to break it down for the audience. What people probably took from it, what it really means.
So the headline that this report has generated is that Miami is the number 1 bubble in this country, in the world. It's a whole sensationalist, catastrophic headline that's been repeated by press worldwide. This has just been all over international and national news, and they have a powerful platform with which to spread this. And when one has, with power comes responsibility. And if you're going to create a report that's
nice Spider-Man quote, thank you for that.
Yes, it's going to generate headlines worldwide that potentially affect markets, decisions, investment decisions, so forth. It is a bank, after all, putting it out.
Yes.
One would hope that the report would not have massive logic flaws, be substantiated, be cited, all these things. And the report is not only self-contradictory, it's opaque in how it actually creates this index and how it weighs it. So my biggest issue right away is in the internal conflicts in the report. When you find contradictions in the logic that are in the actual report, it makes you question everything. Okay. And the fine print, so to speak. So there's this headline, and then they have a page. Page 11 is for Miami. On this page, there are a few columns of text. And they have little small text that nobody reads because most people don't read the entirety of the report. Yep. They kind of repeat the headline. And when you read their actual text, the text does not correlate with the headline. It's on page 11, they write, while price growth is expected to turn negative in the coming quarters, that's their opinion. We're up year over year, by the way, median pricing, but fine. That's not a shocking claim. A sharp correction appears unlikely at this time. However, on their methodology page, page 24, they define bubble risk as, quote, the prevalence of a risk of a large price correction.
Okay.
So they're defining bubble risk as something that has an imminent price correction, and yet on their Miami page, they're saying that no sharp correction appears likely. They then furthermore state, they say a sharp correction appears unlikely at this stage. They continue. Miami's coastal appeal and favorable tax environment continues to attract newcomers from the U.S. West and Northeast, with real estate prices still well below those in New York and Los Angeles. International demand, particularly from Latin America, remains robust, especially the luxury oceanfront condo segment. So that's actually how they describe Miami in the Miami page, which has no semblance to the sensationalist headline that they've published.
And when they've talked about Miami, of course, again, like everything, generalized conversations have no business in real estate. They've talked about Miami, and again, they're talking about Miami-Dade. They're talking about the county of Miami, which is really 19, the way we see it and we sell it at this level, 19 different neighborhoods, 19 different pockets, 19 different, might as well be 19 different cities, all of them doing different things with different demographics, and the numbers are very, very, very different in each and every one. And we're going to get into that because it's very, like we said at the beginning, it's very easy to just take this report and say, okay, BS, let's move on, everything's great. But the reality is, I think it's very, very easy just to take this, dismiss it, and move on and say, okay, everything's great. But I think there is something inherently natural that people look for danger. And because the markets have had such a run for a number of years, and I was thinking about this before the camera rolled, we have buyers who come in since the pandemic and they go, oh my God, I remember when that was half the price, a third of the price, and now it's gone up so much. And because Miami, and we were saying this off camera, Miami has, as one of my guests said a few weeks ago, it's not a serious city. There's a lot of people who come across as a little bit like, a fool is easily parted with his money.
Flashy.
Very flashy, very brash, very quick to make money. And then we usually think quick to make, quick to lose. And so that naturally builds this response of, yeah, so if this went up so fast and these are the type of people that are creating this system, surely it's just a matter of time before stupid people do stupid things and the whole thing comes crashing down.
Right. Agree. But the other point to emphasize is the relationship between irresponsible usage of debt and bubbles crashing.
Which is a great point to get into, because I think if we can understand the actual crowd that exists within Miami, the demographic, then we have a much better chance of understanding the probability of bubbles forming. Not one bubble, but little bubbles. And I think there are, there's what I call deflating balloons, and there are some that are inflating, and then maybe there are some that we might even argue might pop. But I think it's getting into it.
The landscape is not a monolith. There are always pockets that one needs to look at and traverse.
100%.
But as far as systemic bubbles, when people see that headline, they think systemic collapses. That's what bubbles mean to the general public.
Go into the actual definition so people can really understand this, because people read bubbles and they go, oh, really, really bad, but they don't really understand what it means.
Well, it usually is quite bad when a bubble collapses. That's why it's something that is alarmist, and that's why these headlines. So usually.
So what's a real estate bubble? Specifically real estate.
Real estate or any type of asset like this. Bubbles are defined looking backwards. The UBS report mentions this. In fact, you look backwards, you see something quickly crash. That was a bubble, right? Why do asset prices precipitously crash like a house of flaming cards? Why does this happen? Yep. It's almost always some type of interplay between the irresponsible usage of debt and how that elevated the asset price. So all this irresponsible debt comes on board. At some point, the underlying asset can no longer sustain the debt, and the whole thing crashes.
Right.
And people sell because they can't sustain the debt, and it precipitously crashes, right? So this report fails to, despite this alarmist bubble headline, it fails to mention that Miami is a heavily all-cash market, and the higher up you go in price, the more all-cash it is. So past $2,000 a square foot, we're over 80% all-cash, both for condos and for single-family homes. At just $1 million, the condo market in Miami Dade is 74% all cash. So this market is being driven up by cash. Cash is a very solid foundation, and it is not something that is likely to...
and it doesn't surprise us because, let's face it, we are not dealing with low inflation. We're not dealing with an interest or an inflection point where interest rates are very, very low. You're talking about very high interest rates right now, and they've been like this for a while.
Yes, our pricing that you've mentioned that has shot up since COVID, which, yes, at the face of it, if you don't understand what's happening in this market, if you don't dig into the all cash percentages, all these things, and all you see is how quickly price went up, you may naturally think, oh my goodness, prices have shot up so much, this can't go on forever.
Yes.
And if you don't understand that it's a heavy cash market, you might think that it's a scary situation.
Yes.
But it's a heavy, heavy all cash market. And this is all reflected of this shift that we have in our nation of a wealth and talent migration that's happening. And it's still very much early days, and we're on the receiving end of it. And as the report correctly points out, we're still lower priced than New York. And New York is hemorrhaging taxpayers. And this is before Mamdani comes into power.
The big disparity between the haves and the have-nots seems to be ever growing.
Yes.
And this level of separation that exists, obviously the majority of the population, the 99%, and there was a crazy statistic, I'm not sure if you told me this, but it was like, if you took out, yeah, you did, you told me, we were having this conversation before when we were chatting and discussing this. I was driving and you were, I don't know what you were doing, but you told me if you take out the in terms of the average salaries, what people make, and the percentage controlled by the top 1%. Yep. Give me some of those stats, some of those numbers that you shared with me.
Those stats off the top of my head, I want to misquote it. I don't have it in front of me, but it's that to your point, the percentage controlled by a smaller and smaller percentage keeps growing. So the gap keeps widening. And I think this is going to be the trend of our lifetimes, actually. Buffett was quoted about 10, 15 years ago. I think it was in the Wall Street Journal where he talked about this and how this is kind of a natural eventuality in an information-driven economy. And he said that 100 years ago in a more agrarian economy, if you were super smart, you were going to be a little bit richer than your neighbor, right? Because of your aptitude. You were not going to be 1,000 times richer than your neighbor. Mm-hmm. What's happening now is that a small percentage of people avail themselves of technology and interconnectivity, the abilities to scale, whatever it is, make more money. And we're seeing now, if you're super smart, you leave your small town, you go elsewhere, you're making 1,000 times more money than the person that you would have lived next door to. And now I think that with AI coming in, which is going to further supercharge a small percentage of it, it's going to further extend this difference.
So the people, I think, to be clear, when people are watching this video, there's a percentage of the population that will watch a video like this, and they will be making a particular type of income, and it won't be anywhere near what those people who live in the city are making. And I think naturally by that process, it's like, wow, how can anything like this exist? How can a house be,
right?
How can it cost this amount of money?
Right.
Where, the average in the country is whatever it is, $56,000 a year. And then of course you've got people who are buying houses left, right, and center across Miami, and $10 million plus deals are happening every single day. So
we're
people
on record
think,
pace for 30 million plus year deals this year.
Yeah, no, I can absolutely believe it. And I think when that happens, it naturally creates a knee-jerk reaction. But we're not talking to that market. If you are in that group, unfortunately, Miami has become like Monaco. It's become like Dubai. It's become like other cities in the world that have become hyper-focused with wealth. And a lot of the cities that we did see that were focused around wealth, like, obviously I'm a Brit, and there's, one of the podcasts that I enjoy is Diary of a CEO with Stephen Bartlett, who's
it's great.
Super smart guy. He was talking about a number of episodes where we lost 16,000 millionaires this year and 10,000 last year. And guess what? They're going somewhere. They didn't evaporate. They just went somewhere else. Right. And I think if you can really understand the concentration of wealth that exists within Miami and as it grows, and we're not talking about a second or third home. I think it's very clear to say a lot of this is relocation money. And it's here to stay. 100%. And I think when that happens, it starts to create this kind of crazy the crazy stories that we see that people find hard to believe, and
correct.
therefore,
And it creates its own ecosystem, and it
Yes.
creates positive momentum at the point of destination, right?
Yeah.
At the same time, though, these people are leaving someplace, to your point, right?
Yeah.
So in a high tax jurisdiction like New York City, your top 1% of taxpayers account for almost 50% of your tax revenue.
Yeah.
So you lose just 10% of them. What have you done to your tax base? You've decimated it. And at the same time, they're going someplace else.
yeah.
And we've become, so one thing I'm saying is that entrepreneurship flows towards the path of least resistance, and we've become perceived as one of those places. We're perceived now as the path of least resistance.
Globally speaking,
Correct.
across Europeans, North Americans, people from South America, we're even getting buyers now coming from the Middle East.
That's correct.
We are, for the first time, starting to see a drive in that direction, because they originally were buying in the UK, they were buying in cities like Dubai, but now they're saying, okay, well, Miami legitimately seems like a good place to put some money.
That's right.
And look, I think if we were to just do a podcast and to talk about, okay, so it's a bubble, it's not a bubble, Miami's doing great, that would be too transparent, too one-dimensional. What we're going to do is this. We're going to dig in and we're going to look at what were the index points that they created for the UBS report. And they weren't in real estate, and they weren't here in Miami, and maybe we thought that their personal algorithm of calculating a bubble was not what we would create. So we're going to do it better.
What fun.
So we're going to create a better measurement stick for a bubble, and we're going to go through the index points that matter. But in order to do that, let's break down, this is like economics lessons now, let's break down the index points that they use for the bubble and where it starts to fall apart, and then let's reconstruct it in a better way.
So they used 5 sub-indices.
Okay.
In the report, they just display 2 of them, by the way, and they don't even show us the other 3. So there are 2 that they display in the report. One is on price to income ratios, rent to income ratios. Yeah, they on page 8 and 9, they show the price to income ratio sub-index, and then on page 9, the price to rent sub-index.
Okay.
And by the way, in their report, Miami ranks as number 1 and number 2 on the good side on both of these indices that they've published.
Which seems bizarre.
The whole thing is bizarre. That's what I'm saying. They had these glowing paragraph of Miami, and the 2 sub-indices that they actually published were number 1 and number 2, and yet we're the headline as the biggest bubble. But
so let's break down the price to income ratio. Let's start with the first one.
let's
So
just start with
price
that.
to income ratio. So what does that mean? Like, give
They're
me, I'm
taking local
stupid and I don't
incomes.
know anything about this stuff. So help me,
I think
Anna.
they're showing how many years of local income, average local income it would take to purchase a given size, whatever size they use property.
Okay.
So some relationship between local incomes and
So
property.
what they tend to do is, again, when we deconstruct it, they talk about local income. So when you often find these index reports, they're taking the local income across a county. Now, given the fact that we know that there is more separation between the haves and the have-nots than ever before, giving you a blended average of the average in Miami is absolutely redundant. Because the markets, as we see them, that we're obviously talking about, that are the ones that everyone associates with Miami. When they think of Miami, they think of Brickell, downtown Edgewater. They think of Coconut Grove, Coral Gables. They think of Venetian Islands, Miami Beach. They may even think of Bal Harbour, Surfside, and even into Sunny Isles and Aventura. They don't think of all those neighborhoods to the west.
or south.
Or south. And if you look at the average, like the median average home price in Miami is $541,000 or something around there.
It's like 600 something now, but whatever.
I can tell you, I don't know how, I don't know where you can buy it for that number. I'm sure you can, I know you can, but it's just not with any of those markets that I'm talking about. And then the average salary is also going to be sub $100,000. But when we look at the product that we're typically talking about, that is not the 99%. That is the top 10%.
And that
probably
has
less
driven
5%.
the market up.
Yeah. So that first point in itself is kind of redundant because you just blended everything out.
100% correct. And then also back to their point of a bubble where we're going to analyze how stable the floor of the market is. If we're looking at more typically price properties, right? So the median price for single family home in Miami-Dade County is around 600 and change. So if we look at active listings, right? Because a bubble usually implies there's lots of supply, it's going to crash as a demand. Okay, so here's a stat I've been saying forever. Below $500,000, single family homes in Miami-Dade County have lost over 80% of their inventory. In 2019, before COVID, in any given month, there were around 4,000 active listings under $500,000. Right now, there's like 600 and change, and that does not account for things sold for land value, no roof, et cetera. Maybe half of them are livable. So inventory is all quite literally almost disappeared below $500,000 to the single family home market.
Yep.
So that's a very, very strong floor. Where is the bubble even to that point?
Absolutely. And of course, if you're looking at the average salary within a city and you're saying, okay, it's less than $100,000, and then you're looking at condos that are selling for $3, $5, $10, $20, $30 million, of course, you naturally suggest a bubble. But the inventory levels for that product are not what you get when you look at the entire city. When we start segmenting, we did this with Craig Studnicki, he started segmenting the condo market, just as the condo market, 22,000 units, 17,000 of them are in buildings that are 25 years old. And we'll get into the very specific type of product that we're seeing that isn't doing well and the product that is doing well. And then if you get into the newer product and then you get to a certain price point, it dwindles down into the hundreds.
Oh, it's
not
shocking.
even the thousands.
I've done a study for Coral Gables. What was the filter that I used? Active listings for single family below $5 million built after the year 2000 or something like this. There was like 4 or 5. It's shocking.
Well, I'll give you
Almost
one even
nothing.
better. If you look for houses built in the last 10 years in neighborhoods like the Grove and Gables, sub $5 million, you can count them on one hand.
Exactly.
One
right.
hand.
Yes, I know. Exactly.
And I think most of the clients who are engaging with us, that's what they're doing. They're looking at this type of product. So I think it's useful to know. With that said, there's a lot of other things that you do have to be a bit careful of, and we'll get into those risks. But the first point was that income ratio.
Right.
The second one was to do with rental.
Right. Those are the only 2 indices that they displayed of the 5 sub-indices that they allegedly used to create this main index. So they had a price to rent index showing, again, local incomes to rent ratio.
Okay.
But again, we're ranked number 1 and 2 on these indices in their global basket of cities.
Yeah. And the rental income, the money that's made from renting units out, that is a legitimate conversation. When you get into bubbles and you're going to start to pay attention to what can form a bubble, it's when you start to see
a disconnect there.
The disconnect. And usually it's associated that when people get into investment property, there's a certain amount of leverage in the system. People like to invest in real estate because unlike stocks, you don't need to use all of your own money to buy. You can go with 20% down, 30% down if you're a foreign national. And so, of course, there's a certain amount of backloading that you can do in order to buy this product. In the end of the day, once you see a position where the rental returns don't match the value of the asset, then yes, the values go down. And if you see a sudden drop of the rental market, you can suddenly see a balloon of the amount of inventory coming into the market.
Sure.
That, as a framework within economics, makes sense.
Sure.
But that doesn't tell the whole story.
No.
And we have to get into Miami's story specifically, if we're going to talk about Miami's bubble, if you want to call it that. In that specific nature to do with what the rents are and what the properties are selling at and what's happened to the rental market and how leveraged those owners are, those investors that are holding those rental assets.
Correct.
Which we'll get into. So those 2 points were not great.
Agree.
Okay. What's a better way of doing this?
Well, if I look at bubbles, the first thing I look at is the usage of debt versus cash. That's very important.
Okay.
Because you have people who are over-levered with a lot of debt. It changes the math on everything. It changes their pressure to hold the property. It changes everything. That's the first thing that I would look at because most bubbles, again, are created by irresponsible usage of debt.
Right.
So that's point number 1. I would look at that. And then I would also start looking at the patterns at inventory levels. Yeah,
inventory is a really interesting one because if we're going to try to observe a bubble forming, or we're going to predict, because a lot of the conversations that we're having is not what's happening right now. The reason I think a lot of our viewers watch us so avidly is because we're seeing enough bends down the road to see what's going to happen in 6 months from now. Beyond that, it's very, very hard because of macro variables and there's too much, and the world's pretty crazy. So there's a lot of stuff that we can't foresee. But on a very short-term cycle, within 6 months, we can see dangers ahead. When we get into inventory, when you consider dangerous levels of inventory, bubbles forming, at what inventory levels are we talking about if someone's going to say, hey, there's X amount of months of inventory on the market?
So that depends on the price point also, obviously.
That's true. That's very true. Thank you for clearing that up because I think that's something that sometimes people assume that systematically, months of inventory should be the same all across the market.
No, it never is. It never is. It can't be.
Yeah.
A $20 million price point is going to have a far different, good, acceptable time in the market than a $400,000 price point.
For sure. And the number of transactions that exist, the further you move up the food chain,
Fewer buyers,
the fewer
fewer
buyers.
Yeah,
so if
course.
I have, I'll give you a crazy example. If I have only 5 products, 5 houses in the market at a certain price point, and I only had 1 sale in the last 3 years, let's say it's $50 million within a market, you would say, wow, 3 years, okay, so 1 sale in 3 years, it's more inventory. But if you suddenly got another sale tomorrow, you would just double, you would halve your inventory levels.
Spotty data, it's so few
Spotty
transactions.
data, that's the problem. The bigger the data set, the easier it is to
see
play.
Patterns, right?
And I think that's why sometimes when analysts come in and they analyze the city, they work with much bigger data sets because they don't know how to work with smaller data sets.
Correct.
They don't have the way to navigate these numbers because to them, they don't have a clear enough picture to play into pattern, and they don't want to put themselves out there without
Correct.
knowing.
Correct. Now, for lower price points, obviously we have more transactions, right?
Yep.
So you could start to chart them. And so if you're looking, just very simple, eyeball the chart. Make a chart that shows, each month is a data point
Yep.
that shows your active listings, your inventory levels, and all of a sudden you see the slope going up. Boom, you have a drastic increase in inventory.
Absolutely.
It's not that complicated. Just eyeball it. And we don't have this. We had inventory drops post-COVID, right? Inventory has climbed since then. However, now without any segmentation, now versus pre-COVID, both for the condo and single-family home market, we're still below pre-COVID levels.
Yeah. I think understanding the origin points is really important because if you look on just a table, I can make a chart, a graph, a line graph, look horrifying.
Oh, yes.
I can make it do like parabolic curve, like, oh my God, that just...
Depending how you cut it off. Exactly, yeah.
But if you understand what those numbers really, really mean, and you look at them, sometimes, you could double inventory, but it's still not bad. And I did a piece, the Daily Telegraph called me a couple of weeks ago, and they said, we are doing a report, and we're talking about how sales have slowed down so drastically across Miami. And I said, well, you got to know your starting point. Let me give you a story. If I'm driving down the freeway, and you're in your car, and I'm driving the fastest Formula One car that I can get my hands on, and I'm going 250 miles an hour, and you're going at the speed limit of 70. If I slowed down from 250 to 150, people would say, "Oh my!" Statistically speaking, or down to 125. I went down to 125. Easy in math. That guy's speed, he just dropped his speed by 50%.
That's what they're saying about inventory levels. They're saying inventory's up, but it's below pre-COVID.
But that's that's the point. When it's still well below, and I think if you look at the nation, whatever city you're in, if you look at inventory within your nation, and if you want to really understand it, let's say you're coming from New York or California or DC or wherever you're coming from, it really doesn't matter. But if you understand your inventory levels and you understand that price point, and then you look at Miami's inventory levels, it'll give you a much better sense of if it's bad or not. Which Correct. I think sometimes we don't get.
Correct. And you have to look at a whole cycle, 10 plus years, see where you're at. Then you can see if there's been a drastic change, a drastic climb, and so forth. Year over year, again, using your analogy, which was great, year over year is basically that. You're looking at it from this recent thing, but you don't know if that recent thing was good or bad. You have to look at a 10-year cycle.
That's why I like my tool, the Condo Geeks tool that we have is a 25-year cycle.
Yeah. The longer the better.
A lot of people like looking at stuff on a 6-month cycle or a year cycle.
Almost useless.
Journalists do that all the time because they only have last year's data to go from because they haven't been tracking this year on year.
You can't see trends that way at all.
No, and I think that's super dangerous. So going into, let's say, the condo market, when we go under $1 million, what to you is what you would call not bad, not scary inventory? What's good, okay inventory levels?
Even there, I would segment that because between 500 and $1 million is different than sub 500,000.
So let's go 500 to $1 million. This is just for
because the median condo price in Miami-Dade County is 400 and change.
Right.
So, good is going to be 10 months.
Yeah. 10 months is actually exactly what I was going to say. The same. I think 10 months doesn't mean scary. I think we had a lot of, there was a large amount of time, and particularly the housing market actually, where we would see 2 months, 1.5 months of inventory, 3 months of inventory. During the pandemic period, it just bottomed out. So at that price point, when you go up to 1 to 3, I calculated that 14 or 15 months is okay.
Exactly. Yeah, I agree.
And then when I go up to 3 to 5, it goes up to about 17, 18. And then when I go above that, and when I get to like 10 plus,
it's spotty data.
if I see 25 or 30 months of inventory, I'm still not too
because it could
concerned.
change next month with one sale. That's very spotty data at that point. So you have to kind of look at the sub-market.
One of the things about months of inventory that people need to really understand, and I observe this, we've done this for a really long time. I started doing this before the 08 crash. And I always remember the 08 crash story where there was a moment where they had stated there was 15 years supply. So it was like 200 months of inventory, right?
I wasn't here, but I've read this.
It was 200 months of inventory in a brickle market. And that was based off the velocity of sales, right? So if you go from having no sales to 10 sales, you just 10x your months of inventory, or lowered it by 10 times. And so what happened was the car was moving very slowly. It was being pushed along. It was crawling, right? Then what happened was they lowered the prices, and it's like somebody jump-start the engine. And we dropped from something like 15 years of inventory down to 18 months of inventory in less than about 6 months.
That's right.
It just accelerated because everyone started buying. And I think there's a point where there's a critical point of correction. And I use that critical point of correction to help people imagine that it's not, the bubble doesn't pop, it deflates, and it gets to a certain level. And once it gets to that certain level, then a lot more air comes rushing in.
And the air, in our case, is this continuous wealth and talent migration to the region. That's the fundamental driver of all of this. And that's such an important point that they even wrote in their little paragraph on page 11. They talk about the people coming, right? So price is lower. If there's no one to buy, it's not going to help, right? Okay, in our case, we have a steady influx of wealth and talent, of actual taxpayers coming, not only internationally, but also from our domestic feeder jurisdictions. And that's a very powerful trend, and it's in its early days. And the point I've been making is, and this is all quantified through IRS data, census data, all of that, right? So that is a foundational force of what's driving demand. It's this relocation, again, to your point, why we can't put so much weight on local income data, because people are coming in from elsewhere. It's migration, right? So we have to ask ourselves, this force that's coming in that has driven the market post-COVID. And when we look at market metrics, when you look at charts, right, it's always interesting when you see a really steep change, like a drastic change in the data, because then you have to ask yourself, why did that happen? There's a force there that did something that changed the reality of that market, right? When it's a sharp turn. So in our market, we see these very sharp inflection points when we look at higher prices per square foot. We start looking at even 1,000 a foot.
Good thinking here. I hope you're following this, because this is going somewhere.
Right. So even at 1,000 a foot, which now isn't even that crazy high in Miami, right?
Not anymore.
But 2,000 a foot, boom. Past 3,000 a foot, we're up 3,400% in the single family home market. It basically didn't exist, and now it's a thing. So you see this sharp boom, this sharp turn like that, and you say, what exists that didn't exist before? Why is this happening, right? And the what is this domestic wealth and talent migration? And so you have to ask then, okay, so if this were not to continue or to revert, that means that this force would have to go away. And then that's the question, why would it reverse? So what does that mean? For it to reverse, that equals a net exodus.
Those people need to leave.
Yes. That means that these domestic migrants would have to go back to their high tax jurisdictions for this to reverse. Why would they do that? The cat's out of the bag and wealth is mobile.
So I'm just thinking this out loud because this is not rehearsed. We're actually doing this just live on the spot. We're freeballing because that's how we roll. So here's my little narrative for you. If, following the bouncing ball, if the economic strength of a market is based off the top 5%, not the bottom 95%, and look in any economy in the world, how it does that. If the economic strength is based off that top 5%, not the bottom 95%, is it not sensible to calculate and pay attention to the wealth, the accumulative wealth of that top 5%?
Absolutely. It has huge tax base implications, infrastructure implications, everything.
So if we look at the amount of cash in the system, and this is it, this is what we're talking about here. How much cash do we have in our washing machine twirling round? When you look at that top 5%, it's clearly going up. It's not going down.
Exactly.
And if you look at the wealth migration in, and again, this is the reason why there's conversations about parts of California and New York who are now losing money and their economies are suffering and their real estate markets are suffering and are crashing out in pockets, is because it's not the 95%, it's the 5% have left. And that's who you need to be measuring.
Well, back to the point about New York City, like I said before, the top 1% of taxpayers in these high tax jurisdictions account for almost 50% of revenue.
There you go.
It's you lose them, what have you done? It's negative momentum cycles at that point of origin. Meanwhile, we're building positive momentum cycles. And I think that most people are not so good at perceiving or extrapolating trends out of data, because these things don't just magically reverse course. They tend to build steam. And most people don't realize it until it becomes so big.
So how do we measure wealth within neighborhoods, within sectors of the Miami market to suggest whether they're strong or weak? What would be a good way to effectively calculate that?
I look at, I really like to look at a combination of just price points and price per square foot, because higher prices per square foot isolate for new product, not just expensive, but new prime product, right? So I would segment price points, and then also when you look at a segment, look at the inventory trends of that segment next to it. And
so maybe the ratios of that segment. So if I was to divide a market, let's take a market like Brickell, because it's a big market. If you were to look at that market and look at the percentage of ultra luxury product that's sold and compare it from the previous years,
that's right.
One of the ways, if I'm following you correctly, to see if that's economically robust and not a bubble, is to see more of those high-end sales than less of those high-end sales.
Right.
If you see the high-end sales disappear, it means the ultra wealthy are exiting that market and that economy is becoming more fragmented. It's becoming weaker.
The money's going out, right? And you also want to see the relationship between the rate of sales volume versus inventory at those levels too.
Yes.
And what we're actually seeing in our market is that basically the higher up you go in price per square foot, the more we outperform pre-COVID realities, and we're actually up year over year for transaction volume. Yep. And you want to compare that, juxtapose that next to the inventory levels. And while inventory levels are up, they're not up nearly as much as sales volume is, which means that it's actually tightened.
And not only that, which is interesting, and again, we've done this data this year because we do our half-year report and our end-of-year report. There are record-breaking sales across every neighborhood in Miami, every major neighborhood, where the very top of the market, not the median or the average, but the actual top sales are higher than they've ever been
That's
before.
Correct. This is
and
all
there's
throughout
more of
in
them.
Palm Beach also. Same pattern.
Very true. Across the South Florida market, we're seeing... Again, it's really simple. More wealthy buyers buying more expensive real estate. Is there anything else that we should be paying attention to? And I'm wondering about I look at the ratios of rental units within a neighborhood compared to the primary product. When I start to look at economic stability, I categorize 3 areas: primary, investor class product, and second and third home market product. The strongest is the primary. The second strongest is probably the second or the third market, and then the investor market, although I'm not even sure who comes second or third because it kind of can shift. But I feel like when I'm starting to understand the probabilities, and again, this is just probability modeling that we're getting into now. When we get into the probabilities of bubbles forming, there are certain areas that have higher probabilities of bubbles forming by their nature of the type of people that are in those markets. Again, Miami not being a serious city full of unserious people, there are people who are speculators. Investors and speculators, two very different crowds of people. I have conversations with investors all day long, and those are real people with long-term horizons. I also get people calling me and texting me saying, and this is the most typical thing in the world, David, I'm looking for a deal. I think the world's going to crash and I want 60 cents on the dollar.
Yeah.
I will not, if you send me those messages, I'm not replying to you.
I'm not either.
Because I'm just idiot.
Exactly.
It's like day trading. It's the people who are convinced that they can spot that incredible trade. I'm not in the business of finding that GameStop stock or some crazy stock that's going to go up 300% in the day. No one can do that. What I can tell you is I can tell you the stuff that's going to explode and go down and just crash out. But the other stuff, it's much harder, impossible to do. So I think it's interesting to come in with that kind of perspective and look at how we're measuring this. So these investors, those speculators, right, there's a certain crowd, there's a certain neighborhood and a certain product. And I think we're getting We go from the city to the neighborhood to the price
specific
point
product
to the
then.
product.
And this is why you need to combine a macroeconomic approach with actual knowledge of the areas. You have to have both.
100%. Now we get into those. Now we kind of start to figure out. And before we move on into deconstructing the neighborhoods themselves, Anna, rack your brain. Is there anything else that we're missing? Use that big old mathematical master brain to come up with it. Is there anything that we're missing? And again, we can kind of like, as we go through our notes.
I really think of the way my brain works when I think about things, I start trying to identify the primary forces driving what we see around us.
Yeah.
And if you can identify the primary forces, then then the question is, will this force continue? If the force, to me, the primary force is the wealth and talent migration. It's the reshaping
so
of
it's
America.
what you could reframe it as the human behavior.
100%.
And you cannot understand the human behavior if you're not around the humans who are having the behavior. So
and to read the trends.
Analyzing from afar doesn't work.
Well, in a macro perspective, it almost does actually, because from afar, it's the migration across the country. You see it in the data, in the IRS data, the census data, and what's happening around the country.
What does that say? Like, is there any other data that we're missing that can really give people a sense of gravity to the level of why you think the report, justifiably, why that report, apart from the fact who wrote it and how they wrote it, is so absurd?
Oh, I think it's egregious. Like I really think it's what they've done is so reprehensible, because they've put something out that's created this very alarmist headline around the world that has very little bearing to what's happening here, and they contradict it in their own small text. And I think they did it as clickbait. I've had people message me saying that they're selling their book or something, that they're creating some sort of weird manipulation. Who knows? But it ignores the report. Okay, here's my three biggest grievances with this report are that the actual text contradicts the headline, which I think is horrifyingly bad. That just how do you do that? How do you put something out like that?
Yep.
You're acknowledging that your headline doesn't make sense, and while you know it's getting picked up by worldwide press. Two, it almost completely ignores the relationship between debt and bubbles by not focusing on levels of cash. That to me is egregious. And then three, it completely ignores, besides that one little small paragraph where they mention that, we're still below New York and Los Angeles and we're attracting domestic wealth in that little tiny paragraph. Besides that, they fail to acknowledge the gravity of what's happening in America. That it's a huge migration and reshaping of the country and a mass exodus of taxpayers from high tax jurisdictions to more favorable ones. So Florida and Texas are neck and neck. We're basically number one and number two for domestic migration. Mind you, we're 4 times smaller than Texas, and we're attracting the same number of people. And again, why would that reverse? There are all sorts of stats that have come out in the recent years. Like for the first time ever, this was published in the Bloomberg last year, the 7 fastest growing southern states, of which Florida is one, now account for more of national GDP than the Boston, New York, DC corridor. The state of Florida has more assets under management than the state of Connecticut for the first time. That shifted. So there are all these massive wealth shifts underway, and they're not going to reverse.
And the wealth shifts, to be clear, where those wealth shifts are being most felt. And I put this on calculating. This is part of my notes. Thank you, ChatGPT. Calculating risk bubble in Miami. And it says segment approach to bubble risk. Mm-hmm. Primary markets, low risk, right? Primary markets are where that wealth migration is happening too. When migration happens, it's not a second home, it's not an investor product. They are moving, which means the lowest risk of a bubble is a primary market. Mm-hmm. Makes complete sense.
Yep.
And our primary markets in Miami, and I will rattle them off so you can understand them, and they are pockets of them, on the mainland. And I'm talking about wealth here, okay? So there are some neighborhoods that people will talk about, and they'll say, yeah, there's stuff in Southwest Ranches, and there's West, and there's other stuff going on. But the wealth that I see, the highest concentration of wealth, is going to Pinecrest, Coral Gables, Coconut Grove. There's Miami Beach, the Venetian Islands, the gated communities within Miami, so Bay Point, which is a kind of a gated community, and all the ones in Coral Gables and Coconut Grove. There are also pockets as you move north. We see it. We'll see it in Fort Lauderdale. We'll see it in Southwest Ranches even. Mm-hmm. We'll see Palm Beach, big recipient. Any neighborhood that is typically single family, great schools. Single family, great schools, right? If you tell me there's a bubble in those markets, you can...
I concur.
Fuzz that out, right? That is just, it's crazy for someone to imagine that, because at the end of the day, yes, the prices are high, but geographically, please understand the size of these areas that we're talking about.
All the areas you mentioned are largely single-family communities, and you can't add more inventory vertically. Ding, ding, ding. There's also
land is the one thing they're not building any more of.
Correct. And we're going to keep attracting all these people, and yet that land is very finite.
Yeah.
And it's over 80% cash in all those areas.
So there's none of the correlating indexes, none of the statistics,
it's
none
so
of the information
painful.
we can give.
I mean, they didn't even, if they want to focus on a problem area of the market, which they did not do as a specific, they could talk about older condos.
And we're going to get into that.
Right.
Given the fact that the primary market's off the table, okay, no bubble. Let's move on to the next group. Rental-heavy urban markets. Moderate risk, but only in regulatory tax environmental changes, if regulations and tax environmental changes. So the rental market in these areas, interestingly enough, and I know this is going to help you segue into these older buildings, but I'm going to hold you off from talking about that just for a moment. I was speaking to my territory managers, of which I've got 15 stellar agents spread through 3 counties, and they live, eat, breathe, and sleep the neighborhoods that they work. And I called 2 of my biggest agents who cover big urban markets, the Beach and Brickell Downtown and Edgewater. Both cases, interestingly enough, I asked them, how's the rental market doing in these areas? And they said to me, and I quote, the rental market seems to be down around 15% on average. Mm-hmm. However, the older buildings I'm seeing have gone down significantly, but there are specific buildings that have gone up in rental income. And Stefania Camberroyal, my Beach agent, quoted for me a building, which is 5 Park, where she was actually recently completed new building. And she said, I was anticipating $9,000 a month for this 2-bedroom units that we were getting, and we were getting 15. That's a pretty big jump. I mean,
significant percentage difference.
Percentage-wise, put that in your pipe and smoke it. Mm-hmm. It was shocking. And then obviously the same thing I asked Shakira Sanchez, who handles my Brickell market and downtown market. I said, tell me what's going on. She goes, the generic product is down. Mm-hmm. I've seen stuff that is like, there's rental markets haven't collapsed. No collapse, softened. Mm-hmm. But I've seen other product actually go up. Mm-hmm. And I think this is more about the crowd who lives in Miami shifts. Every day someone talks about people leaving, and there's a lot of go on YouTube, and I don't want to criticize, but typically the videos that I watch where people say everyone's leaving Miami, they're 25-year-old influencer who's decided that their rent in Brickell is too much and they're moving north, right?
Listen, there's always an anecdotal story. Nothing is.
But that's
really
not that's
the net that matters.
Yeah, those people obviously write those stories. But for every person that leaves who can't afford it, there's a person who's coming in who can afford it.
There actually is a documented phenomena of income replacement in Miami-Dade County. The incomes of the people coming in versus going out.
What's that tell us? What's that?
Oh, that people who are moving in have a higher median income than the people moving out. So.
That's just a form of wealth migration.
Yeah, correct. Income replacement. People are going to Broward, they're going to elsewhere in the state of Florida, but correct. That's just to your point.
Okay.
Yes.
So then the next thing is the second market, the second home market and the beach markets, where risk depends on international capital flow. This is ChatGPT calling, so we don't have to kind of agree with this, but we can kind of break this down. So Miami has always been a recipient of international cash flow. And I think it's probably always going to be a recipient of international cash flow, because there's always, for now, the US is still a dominant economy in the world, and there is a lot of safety and comfort and familiarity.
Sure. For the Latin American community, he's always come here.
With Miami,
What is the quote that when Latin American governments go left, the money goes north? And now the same thing can be said for
the north to south. When people go left, and so politically speaking, everyone goes south.
New York, it's going to go left, and the money's going to come further south because Mamdani's quoting the Communist Manifesto.
Yeah. So second home markets are now obviously, in my mind, houses that were being owned by individuals who had it as a holiday home are getting bought out by people who are buying it as a primary home. Mm-hmm. And I think that's fair to say, because the inventory for the housing market's too low.
Correct.
Very tight. So the beach market's okay. If we look at the beach market this year, it's doing... Now, it has softened in certain areas, and that probably has a lot more to do with the age of the homes, much like the condos. because of insurance and because of elevation levels, houses built on lower levels are harder to insure, more expensive and less attractive, and people would rather have a new home. If we were segmenting as we go through our segment process, new versus old is a big part of this conversation.
Huge across the market, across the whole market, actually. New versus old is a big differentiator in performance.
Huge variables. And the beach market for the condos has softened somewhat because the product that hasn't been doing well has softened. So if you look, and I'll give you some working examples, so this isn't just academic. If you look at St. Regis in Bal Harbour, if you look at a number of other buildings across the beach markets that were, second home markets, those prices have softened a little bit because they got very expensive. I sold a unit at St. Regis that was $3.5–4 million, and then it went up to like $7. And of course, there's a certain level where why wasn't it selling this year? Because there was enough other luxury product to replace it, including new construction, which is a very important part of our system.
A higher standard now than the previous.
Exactly.
Product.
And when I talk about new construction, we're talking about there's a lot of very high level, very, very high level new construction. But the top level newer product, well-built product, ultra luxury product has gone up this year on the beach.
Yes, it has.
Four Seasons Surfside hit $6,600 a square foot, $6,000 a square foot. There have been a number of record-breaking sales. If the bubble's happening, then why are we seeing this occurring?
And they're cash. They're heavily cash purchases.
Yeah, these people aren't leveraged. So and again, actually right now, interestingly, we just came off the back of seeing a development, and they actually said to us directly, we're seeing more cash flow coming from South American economies again.
I've heard this too.
There's 3 or 4 countries, Argentina's one, Mexico's one, there's a few others in there as well, where that we're now seeing, and we hadn't had it for a while. And I always said this a long time ago, I said, we are having a great time during that period post-COVID where everyone came rushing down from New York or California. And I said, imagine what will happen when the South American money returns.
Exactly.
Now we're starting to see that. So that's just something that
it's always a cycle from there. There's always the next wave.
Yeah, they have that. And then the final market is our luxury market, which is often decoupled from local supply-demand fundamentals, which is definitely decoupled.
Completely. It's global wealth, mobility of global wealth.
It's a low risk of traditional bubbles. And it's global wealth. I've got a friend of mine who was at Goldman, and he said he's managing 1,500 people with $100 million or more of value each. I'm like, it's billions of dollars. And I'm like, that many people in South Florida? And he goes, yep, that many people. So with that in mind, now we've kind of gone through what the index points we like to pay attention to in specific. We've got the primary markets out. We've got there's rental markets. Let's get into the other markets and where we're starting to see some, if you want to call it a bubble, if you want to call it risk, if you want to know where not to go.
Challenges.
This is the part of the podcast that you start to pay attention to the things that you shouldn't be buying, because we're not all kumbaya. I think it would just be irresponsible, and it'd probably just be wrong to start saying that you can come into Miami and buy anything. Let's get into the stuff that gets sticky. Anna.
Okay.
Tell me.
Older condos, I said it before.
There are markets where I look that I see a high concentration of older product. And I think I've noticed this. There are definitely parts of the beach. As I drive through parts of the beach, I suddenly go from nice shiny buildings to that mid-beach, high beach area when I'm like, oh, this is scratchy. Where do you see these areas and these pockets of older buildings? Where does the risk lie?
Wherever there's a pocket, Miami Beach is a great example because Miami Beach is very difficult to build in. They have these historic areas that are difficult. It's very difficult to get projects approved, et cetera, et cetera.
Yeah.
So just any place outside South Florida, you see these older buildings.
And those beach areas are also environmentally more challenged as well.
That's right. So it's just difficult. And those products were lagging before, and now they're lagging even more. Do
you think, it's a really touchy subject for most, but when we saw that reevaluation of condos due to the Chaplin Tower collapse, and we went from the 40-year assessment to the 25-year assessment,
and the requirement for reserves.
And the requirements for reserves, you need to accrue 10% every year on top of what you've got.
So many older buildings have seen a doubling, even tripling of their HOAs because they had kicked the can down the line.
So there's the bubble. The reason is not just explaining where the bubble lies, but why it exists today. That rise in HOA fees, that rising cost, that closing down of the pool deck, that redoing of the main lobby area, the actual structural resupporting of the rebar underneath so you don't get a building collapse, that type of cost, which is rising to higher HOAs, and then the buildings are still old, still dated, still low ceilings.
Throwing good money after bad.
Yeah.
In many cases, unfortunately, because it's not like they're going to pay once and be done. They're going to have assessments.
Those are the ones that we see just no sales coming out.
Yeah, it's very difficult because you're going to buy it. There are going to be assessments forever.
Yeah.
It's just they had issues.
It's like buying a really old car that's like the engine's blown and it's knackered.
Yeah.
And it's not going to suddenly get better.
No, it's a real issue. I mean, it's a real issue. And again, not all old buildings are in the same boat.
No.
Some of them were managed
well.
well.
I think some are
So that's the thing. You have to correct. And for the ones that were managed better, they're actually in a pretty good position because they have price points that can no longer be built anymore.
Yeah.
So new construction can't be delivered. I keep saying below $1,000 a foot. Even that's pushing it now. Everything is really higher.
No, it is absolutely
let's
gone
just,
higher.
Just pretend it's even $1,000 a foot, right? And it's more than that. If you can't deliver product for less than that, how could you possibly build a 2-bedroom condo and sell it for $400,000? You cannot. But these older buildings have those price points. So for the ones that are not complete disasters, that weren't irresponsibly managed, they're actually offering product at prices that can't be replaced.
Yeah, and I think that the challenge there is that because there is a lot of product that is bad,
correct,
it's very hard to navigate that.
Very hard.
Older buildings are very hard to navigate, which is why, shameless plug, we've done a report of the best 3 and the worst 3 performing condos in each and every neighborhood in Miami. Yeah. And it's not out yet, but it's coming out soon. And I've drilled every territory manager at the David Siddons Group has been given the task of identifying the best 3 and the worst 3 buildings in their neighborhood and why, explaining the environment, the buildings and everything going on around. And I think that will really help those people understand where we see things going, where you need to stay away. Because that's where we see inventory rising. And those are the people who, when you talk about financial strain, you talk about bubbles being where people cannot sustain it because financially they're getting over their skis. Or it's just they have to sell. Like when people end up in a bubble, like the 2000 crash that we saw, the 2000 tech bubble that we saw, that was an example of people getting way over leveraged, everyone diving in because they wanted to make money. It was a quick flip, right? When we see that obviously we totally get and understand a bubble. And I think when we start to see people who can't sustain a certain system and then they economically, personally collapse, they have to sell. I can see that happening.
That's called price discovery. That's what happens then. They have to sell, prices keep dropping, and that's what happens.
And that's when it goes, boom.
Yep.
That's the product that if you were to identify bubbles in areas, and we do have those bubbles on Miami Beach, we have them up in Bal Harbour, Surfside, we have them in Sunny Isles, you have them in Brickell, downtown and Edgewater, you have them systematically across the market. They're a little bit more at risk on the beach because of the environment and the cost of maintaining those buildings is higher, but they exist almost everywhere.
Yep.
Then outside of that, if we take that off the table, and I think everyone can watch this and go, you know what? All right, okay, I'm not going to buy an old building. I get it. I get your point, David. Anna, I get it. Let's move on. Let's move to some of the stuff that might be less obvious. And again, we don't have to even talk neighborhoods. We can get even specific down to what I consider high-risk buildings, where I have my own theories on those. But I'd love to see if you've got any thoughts
sometimes we see things. We see even with newer product, you can see things delivered that all of a sudden have a glut of listings that aren't selling upon closing.
You know what I'm talking about?
No, I think I do.
I do. There's several podcasts we did before this, and we talked about this. There's a number of buildings that have inventories ballooned. It's ballooned in those buildings. And I think a lot of it, a very high percentage. And systematically, what I often find, and again, we did a podcast on branding where we talked about, the branding, I actually titled it Branding Arbitrage, or the brand mirage. Thank you. The branding mirage. But my guest called it brand fuckery. She was like really direct. And she was like, no, it's this worse. And she really called it out. And there's a lot of brands. And again, this is where the whole Are People Serious in Miami? There's a lot of brands that come out and you're like, this is going to end really badly. And if you want to talk about a bubble, I think that's a psychological bubble. That's a psychological illusion. That is the illusion of quality and cost to suddenly see things drop. And we see that in the car market, we see it in the fashion market, and we see it in the condo market.
People think some new shiny thing is gonna like float them off into
and they were willing to pay for it, and then they realized the thing wasn't that shiny.
Right, or that no one else cares as much as they did.
Yeah. It was gold leaf on something that they thought was real gold. And I think that what we've seen now, and I think this is where sometimes journalists from other sources see what happens within certain buildings, and they go, "Oh, that was bad. Oh, look over there, that was bad." And then they go, "Well, if it was bad there, where else is it?" And then they kind of just expand backwards. And I think there's always a shining example of a really badly behaved kid in class. And then you go, "Well, it's a school full of delinquents." But in that case, there's a number of buildings that, again, pick up the phone, give me a call, I'll tell you what they are. There's a number of buildings that really were what you might classify as bubbles. They sold high. They sold initially high from developers at numbers.
Like a micro bubble. The little building
micro bubbles. Thank you. And then they just start to tip off and go down and down.
And we see tons and tons of listings in them and very little movement.
Yeah.
And for anyone who wants to sell, when you have 60, 70 listings in a building, how do you sell? You have to be the lowest price. That's the only way.
Yeah, it is. It's a falling knife scenario. It's a chase to the bottom, lowest denominator. What I found was interesting is when you see bubbles forming or micro bubbles forming in areas where there's what would be considered saturation of product. So if you're in a market, which is good example, lots and lots of rentals, and you're introducing 5 more buildings, and they're all rental buildings, your population's going up, but it's not going up that fast. And I think that tends to kind of come in and compound. Right. So I think that there's that kind of element of mini systems, areas which are very, very heavy rental based, quadrants that are really, really heavy rental based, and types of product that's rental based. So I always think of, like, at a granular level, square footage. Like very small units, micro units. Like there's a funny movie called Wanderlust. I don't know if you ever see it. No. And it's Paul Rudd, and he goes with his wife, and he goes, "I've been sold an apartment in New York City. It's a micro loft." And she sells it to him as a premium, and then he has to sell it because he loses his job, and he goes, "I need to sell you my micro loft back." And she's like, "Grow up, call it what it is. It's a goddamn studio." And the joke is that it's like it's being marketed as one thing, but the reality is very clear that it's just a studio. And
it's a room, dude.
It's a room. It's call it what it is. It's a room. There's a sink, there's a bed, everything's there. The product that we have in Miami, there's a lot of, like, what I call rental. It will always be rental-based product. And I see micro bubbles forming in the short-term rental markets. Those tend to kind of like the Airbnb thing was a good example. Right. That to me was like a little bubble.
Right. There's a lot of short-term rental in the pipeline, and like half of the pipeline. Yeah. Yeah. And there's big differentiators within that product. There's successful ones and ones that I felt have jumped on the bandwagon.
Yeah. Which I think typically often happens when a market like Miami has a great financial economy and there's a lot of money.
A lot of tourism. Our airport keeps hitting record traffic.
Yeah. I mean, again, I try to get into the process of infrastructure. Often when you get to bubbles, you see things collapse because the system can't sustain it. And then obviously money then just vanishes. And, if we look at our 2008 crash, everyone always remembers the 2008 crash. That was like the bubble, the big crash. And if we all remember that, and if you go back and you remember what happened, it was like no one was buying. No one was interested. No one wanted to be here. It was like, I'm not going to buy it. Well, I think people wanted to be here. They just didn't have the liquidity to do it. One of the arguments that comes out with bubble conversation partially may have to do, and I was hypothesizing over this, is the fact that our stock market has had such a bull run in 2025. And the market's gone up so much, and there's so much wealth created. There's always, every month, if you look, and again, no surprise because it's clickbait, on YouTube, every single week almost, there's a video talking about market crash.
For the last 20 years. Yeah. There's always someone talking about a crash. This is going to crash. Silver's going to crash. The market's going to crash. Yeah. Gold is going to crash. Bitcoin's going to crash. Yeah. There's this whole genre of thought that these people just are waiting for things to crash. There's a natural,
and if you state it long enough, At some point,
broken
you're
clock is going to be right. But listen, like
once a day. Exactly.
How much of upside have you missed in life? Have you missed? And do you want to spend your time on this earth for prophesying demise? Is this how you want to live?
There's a great book that I read, and it's called a Brief History of the End of the Fucking World.
Oh,
and it's brilliantly written, and it's all about the fact that in our human nature we are I know it's just built into our DNA to naturally look for change. And major change is always like, it's coming.
Change freaks people out.
It does.
It freaks people out.
And that's what you said this before in your reports. People never realize it. They never see it until it happens. They never believe it.
No.
It's just,
even though change is such a constant, I realize that most people either don't think or read about history very much because change is the only constant. And if you tell people, look how different life was 100 years ago. 50 years ago, how different was life?
Yeah.
And that was before the internet.
5 years ago with AI. No,
right?
12 months ago.
Right. So if the world changed so much in all these tangible ways in 50 years, it was so drastically different. Why? First of all, the change is going to speed up because of interconnectivity, and the world's going to be drastically different. And also, I tell people this, and they say, listen, I grew up in New York City. I love New York City. I lived there till I was went to school there till I was 26, 27 years old. I wish New York well. But New York was the capital of the 20th century world. Before New York, London was the capital of the world. London is still there. It's a big city. It didn't blow up. There's just a shift in focus. So it's not even a dramatic statement like there's a demise. No, there's a shift in financial focus. It's inevitable.
And it's shifted a lot in the last 12 months. London's financial focus has massively shifted.
They're hemorrhaging millionaires over there. I know that. Yeah. And then in terms of the States, we have this, like I mentioned, we have this shift away from the Northeast in terms of contributions to GDP, AUM, whatever, all these things, right? So the world that New York was the capital of was a pre-internet 20th century post-World War II world. It's never going to stay that forever. How could it? Nothing ever stays the same, right? And we have to identify where the forces are pushing wealth and creation. It's not going to stay stagnant. And it gets pushed again towards the path of least resistance, and wealth is increasingly global.
And the needs of the wealthy, I think, have to be recognized. When we get into Miami and we look at the product that won't do well, systematically we realize very quickly that the product that does not fit the wealthy is old, is small, doesn't have good views, isn't well finished.
Well,
the product that everybody wants, and the success of the new condo market is a really good example of seeing that, because we see what goes on the MLS. But I can tell you many neighborhoods, including places like Coconut Grove, new construction is outselling resales 3-1.
Oh, yes.
Because we don't have inventory
and it's
in the
built
resale
to a higher
product.
standard, because the new construction is being
Completely
built
different.
to it's being built in accordance with the city's new stature in this post-COVID world. Architects, all of this. It's a completely new standard.
The need is there, but the supply of luxury product is far smaller than we realize.
No, I know.
I was yesterday. I was in Coconut Grove. Of course, this is a market I do a lot of, and I was in the Four Seasons, which I've just done a video that comes out. Actually, by the time this comes out, that video will be online. So if you want to understand the Four Seasons Coconut Grove, watch it. I was there with a client, and we were looking at the O1 line, which is the best line in the building, and there's only 2 units available. 2 units available in the whole of that line now. Half the building's already sold, and they launched their sales office literally less than 2 weeks ago. I was the first agent in the city to report about that. And why is that? Why am I mentioning that? Why is that important? Because the needs of the ultra wealthy and the wealthy are not being met by the amount of inventory available. The supply of our product is limited. So I think if you're watching this and you are a mid to luxury buyer, if you're someone who's moving here and you see the UBS report about a bubble, and you're thinking, well, maybe I should rent for a while.
No.
Hopefully by the time you've watched this and you look at the article that goes with this, you'll realize very quickly that that can't be a sensible conversation.
No, and again, to your point, the new prime product is at higher prices per square foot because it's built to a higher standard. And if we track resale volume at higher prices per square foot, we're up year over year. We're at record volume. Inventory has not kept up.
It
is what it is.
Way up.
It is
way
what
up.
it is.
Frighteningly up. I mean, again, if we look at the amount of $10 million, let's do it. Let's just do it as an exercise.
Right.
How many $10 million sales did we have last year? Oh, no, let's go back a little bit. How many $10 million sales did we have in 2022? How many $10 million plus sales did we have in 2023? How many did we have in 2024? And how many have we had in 2025? I rest my case. I think that I wanted to kind of like finish this with the, getting into this wrapping this up, and obviously UBS is interestingly misleading for Miami.
It's clickbait, sensationalist clickbait. They've gotten coverage all around the world for their report, sort of convoluting our success story into one of a bubble, which is absolutely inaccurate. They should be. I'm not going to mince words on this. I think what they put out is a travesty, and they should be embarrassed.
And because they generalized about an entire market, not written by people who do sell real estate, who don't live in Miami, don't live in the city, don't even live in the US. They don't appreciate this highly segmented. It's not a monolith.
Their fine print contradicts their own headline. That to me is so egregious.
Is there anything, giving them some glimmer of hope, is there anything that could create a bubble within the Miami market? In your opinion?
Anything.
What would be a higher probability of something that would create a bubble?
We would have to change the entire migration patterns of wealth across the world and the country, and I don't see that happening. That is the primary force. So what was driving these record sales at higher prices? That's what's driving record sales volume from new prime product. That is the underlying force. So why would we see a net exodus of productive people back to high tax states that they're fleeing? We're not going to see that. Why would that change? So that is the fundamental force, and it's a very, very obvious trend, and that's really what's driving this market. And then, of course, now we're on the global stage also and getting global wealth. So for this to reverse those realities, for our market strength to dissipate and go away, we would have to become hostile to wealth.
Doesn't seem very likely.
No.
And then when buyers are looking for what they should be focused on to avoid any bubbled markets, it's like what I call the long-term fundamentals. Mm-hmm. Not the headlines. Mm-hmm. The long-term 100%. Fundamentals of human need at a high level. Yes. And again, we have this conversation about the day in the life of. Once you satisfy the fundamental needs of human beings' lifestyle,
right?
Commutability, driving to the office, driving to the schools, being able to live in it as something that you can actually live in for a long period of time, primary or long-term, secondary or whatever it is. And then, from there, I think that Miami would have to stop being an attractive place to live.
100% correct.
Which doesn't seem very likely either. It would have to become unsafe.
Yes.
It would become high risk in other capacities.
Right. So in addition to all the economic benefits, we're also a very pleasant, nice place to live. It's not like you get all these economic benefits, but you have to live in a cold, miserable place. Do you know what I mean? We have all these economic and benefits, and we're a wonderful, healthy place to live. So it's a wonderful, it's a great package.
So we'd need an ice age, basically. We'd have to really
but if we get an ice age, so does everybody else.
Yeah, exactly. Okay. So, Anna, thank you for doing this podcast. I think it's been great. I would encourage everyone who subscribes to our channel, reach out, look at our neighborhood reports. Each neighborhood really details what's going with those markets, the good and the bad, because we like to talk about the bad as well as the good. We detail with graphs and tables. We show you where the market's moving. We segment our markets. We have hyper-specific data on individual condos as well as neighborhoods. We are even working on a predictive model right now that will predict market movements within buildings next year. And as always, thank you, your wealth of knowledge. I really appreciate this.
It's just like year 6, I think.
It is. I feel like this is
we have a whole series.
and it's great to know that this is not. I like that you said that, because this isn't a one-off. I mean, we've documented the Miami market for many years. We put
ourselves on record. That's something to be said for that.
And I think that, and we don't hide behind anything. Like, if you want me, you know where to find me. Numbers, emails below. Open to a chat. Anna,
thank you so much.
Thank you so much.
Thank you.
Thank you for watching. Hope you enjoyed this episode. Stay tuned soon for another Better Decisions podcast.